Oh, hi, friends. Josh Yeager, trustee governance nabob, out on a walk with Dodger. Thinks he's a cow. And thought we'd continue our conversation on the duties, responsibilities, and process for prudent trust administration. Today, I thought we'd spend a little time on the trustee's duty to account. And this falls under the trustee's duty of loyalty to the beneficiaries. Remember from a prior conversation, we said that the trustee's duties fall generally into the duties of loyalty and the duties of care. So within the duty of loyalty, there's a sub-duty of the duty to provide the beneficiary an account or a report. This is not an accounting. This is in the tax return. This is a report on what's gone on in the trust during the last year. Most states have this in their statutory scheme, that it is a proactive responsibility of the trustee to provide this. There are a few states, Delaware, Nevada, South Dakota, one of the Carolinas, I think, that say that the trustee only has this duty if the beneficiary asks them to provide an account. But for the sake of the conversation, we're going to assume you're in one of the jurisdictions where the account is required of the trustee to proactively do. Now, what is the account? The account's a report that goes to the beneficiary that lets them know at a high level what's going on in the trust over the last year. And fulfilling this duty, my friends, is one of the most easy ways for a trustee to dramatically reduce the risk of the administration and their potential liability for future lawsuits and hassles, etc. Because if one fulfills the account responsibility, if they provide the beneficiary the things that the statute says you're supposed to provide them, then the statute of limitations begins. The clock starts ticking. And in most states, if the beneficiary wants to sue you over something, they can't sue you for anything farther away than 3 years since you provided the account. So the maximum liability for you would be 3 years. This is just a huge risk mitigation strategy. It is a much stronger strategy than buying E&O insurance, which is risk shifting. It's honestly a better strategy than hiring a fiduciary governance nabob like myself to develop and maintain your governance processes for all of your duties and responsibilities. This is like the big one. Now, what goes into the account? I don't want you to be confused by the word. The annual account is not a formal court accounting. That's something different. The formal court accounting is what usually a CPA does when there's trial pending and people are arguing over on what day did pennies and nickels come into the trust and whether they were allocated to the correct buckets of principal or income. That's a gnarly accounting. That's like a forensic accounting. Those are very expensive. Those end up being, dozens and dozens of pages long. That's not what I'm talking about. The account that I'm talking about has the following elements. One, it has a statement or a balance sheet of what was held in the trust at the beginning of the accounting period. And then it has a summary of all of the income that was produced by the trust assets, and all of the distributions to the beneficiary, all of the disbursements, expenses from the trust, and then an ending balance sheet. Now, this account does not have to have all of the transactions within it to fulfill the trustee's duty. So you don't have to have every dividend or interest payment that came into the Merrill Lynch account. You don't have to have a recitation of every date the trustee got paid from the trust. It's just it's the summary for the year. Now, there's a couple of important elements in the account after you have provided the beginning balance, kind of a statement of cash flows and ending balance. There's a couple of disclosures that are really important to make, or else the account won't count as an account. And these are the following. One, the trustee needs to specifically call out what they got paid. We can't just say total disbursements from the trust were X. We have to call out within the total disbursements, a portion of those were for the trustees' reasonable compensation. And we need to identify that for the beneficiary. We also need to identify any relationships that the trustee may have with other agents or delegatees that they're using. So if the property manager is the trustee's kid or spouse, we need to call that out and describe what they're getting paid. We also need to give the beneficiary notice that the beneficiary has the right to have this account reviewed by the court if they want to. That's one of the rights that a beneficiary has, is to say, hey, look, if I want more information, I should be able to have a third party review this thing. Now, in my experience, some helpful language in the account is, look, here's the account for the year. If you want any more information or supporting documentation, happy to provide that. The door of the office of the trustee is open to you. You do have the right to have this account reviewed by the courts, but that's kind of an expensive and onerous process, which is going to be paid by the trust. So we should probably just work it out between each other if you have any specific questions. I'll provide you whatever supporting data you need. In my experience, that gets rid of the risk of the beneficiary quickly jumping and getting an attorney and getting a CPA and opening up Pandora's box on all the nickels and dimes of the administration. So that's one element. Got to give the beneficiary notice they have right to have the account reviewed by the courts. You also have to give the beneficiary notice that by failing to challenge the account, the 3-year statute of limitations time period begins. So if we go through that exercise, we take the trustee's risk dramatically down from the period that they began the administration, let's say years and years ago, and we cut it off, we truncate the risk just to the period of today when the account is filed in 3 years going forward. Massive risk mitigation strategy. Now here's the thing that's confounding to me. Trustees aren't doing this. Many trustees provide the beneficiary the Merrill Lynch statement and the tax return for their file, but that's not a sufficient account because it doesn't call out the trustee's fees, doesn't disclose any relationships, doesn't have a beginning and ending balance. I have asked my CPA, why is it that CPAs don't provide this as a service for those clients that they're preparing the trust tax return for? And the answer is, well, CPAs are more interested in the cash flows, the K-1s, the rental income, the 1099s from the assets of the trust. They're not really in a position to record the beginning balance and ending balance. So they only have half of the story. So because they only have half of the story, it would be inappropriate for most CPAs to prepare this thing. Now, if they had a balance sheet that they maintain for you, my experience is that some few CPAs provide this as a service in conjunction with the preparation of the tax return. But the vast majority, I'd say probably 80%, do not. And the result is, because the beneficiary or the trustees don't know that this is a distinct thing that they're supposed to do, I'm going to guess that 80% of trustees are not filing an annual account to the beneficiary. They're providing them some information, but that information, in my experience, is insufficient to meet the requirements of the statute. So, it's important to do this stuff, people. It's not terribly complicated to do. Hop on Google and search in your state's probate code what the duties to account are. 16063 is the California statute. That's uniform trust language. Pretty much all states have the same language around this, except for the carve-outs that I described earlier. So, let's get those accounts done. It's good for the bennies. It's really good for the trustee. It's not that terribly hard to do. It's a critical planning process. And frankly, it's part of your job. So, do your job. Thanks, folks. Ciao.